Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. Tuesday, the 9th of July, 2024, 1 o'clock on the East Coast. Guy, Adami, Dan, Nathan, joined shortly by the great Carter Worth. That, of course, of Worth Charting. How are you?
I'm doing great, Guy, Adami. Not knotted up today.
Not knotted up, but I got the energy. I got it all going on. I am not headed into New York City's Times Square this evening for CNBC's Fast Money. So I'll be getting some work done post-market call. And by the way, I think we're laying down some OK computer tracks. Is that what the kids
you and I, we're going to probably take it easy on the tech stuff today because it's going to be in the OKC. So that will drop in your favorite podcast store. Tomorrow morning, you're going to get plenty of Guy, Adami, and me. Guy, by the way, we've been using that little riff, you know what I mean, to come into market call, I think for years now. And I feel like you would much prefer, maybe there's something from the Stevie Ray Vaughan family of guitar riff.
It's funny. Like now, Amanda's going to yell at me because, this is not, it's, you set me up for this. The short answer to that is yes.
Yes.
I would love something from the Stevie Ray Vaughan family. Unfortunately, I think there's like licensing issues. You're not allowed to use certain things because trust me, if we were, I'd be changing that shit up every day. And I'm not supposed to curse either. So
I have an idea.
Okay,
so,
good.
These new AI bots, this sort of stuff here.
We have Brunson.
We do have Brunson. We could actually go into one of these language models or one of the ones that does voice, and we could actually ask it to do something from the Stevie Ray Vaughan family.
No.
Really?
That's sacrilege. No, I saw some advertisement. I got my Vanity Fair yesterday. And I still get the actual mag. No, I'm just,
it's a glossy magazine.
And one of the advertisements was a picture of a young woman, and then there were like 8 pictures of women next to it. And they actually put in the ad that part of the ad was AI generated, and I was so offended by that. Like it actually, I was in such a good mood, as Damone said, and then put me in such a bad mood. So no, AI will ex Brunson.
Yeah,
AI will never be part of my life in any way, shape, or form.
Fair enough. Not to bury the lead. We're going to have Carter Worth of
I
Worth
said
Charting.
that.
He's going to join us in a second. Guys, should we just get to the rundown?
Get on the rundown because Amanda's yelling at me already.
Yeah, of course she is.
How high can stocks go? Well, apparently pretty damn high. Chart check on crude, gold, and Bitcoin. That's with Carter. And, those are 3 things that actually are interesting charts. Bitcoin is obviously not traded well for the last, 3 weeks or so. The restaurant route continues. Man, oh man, McDonald's just can't get out of its own way. And if we have some time, Dan, a little audience Q&A.
That would be great. So somebody just hit me, a market participant who I've known for a long time, and he said he's watching the halftime.
So should I be nervous?
No, and he said one of the participants, he didn't name a name, and I don't even know who's on. I'm not watching it, said something like, there are so many great setups in the market right now. And I just thought that was really interesting. Somebody said, well, the guy said to me, that's got to be the top, right? And I told you that story about early, 2000, where we had a guy who was not a market guy, but he was an analyst. And this was when all those telecom and the equipment companies and all that sort of CLEX and everything was going crazy. And one day in early 2000, this is for those who haven't heard this story, he stands up in kind of broken English. I'm not going to do it because, again, I'll probably get canceled. But he said something like, the market will never go down again. And that was it, people. I mean, like, it was early March of 2000. I mean, we all looked at him and said, sell everything. Okay. Yeah. So I think we're getting a little of that stuff.
Again, Liz and I talked about this yesterday. Yeah. Maybe there are great setups, and maybe I'm blinded by, all my sort of dourness and my want to sort of find things that are wrong. But I will tell you, and we've talked about, and again, I've said it 1,000 times, valuations in terms of PE multiples and those types of things, they are not timing mechanisms at all. But when they do, just as they're not timing mechanisms, to not talk about them is equally, I think, a bad thing to do. So you have to bring it up. And with each passing day, and Doug Cass mentioned this earlier, I want to say, 86% or so of this rally is predicated on multiple expansion, and maybe the other 14% on potential earnings growth, if in fact we get it. So I'm hard pressed to understand how that's a healthy mix.
All right, let's pull up a Oracle day chart. This was the O in your hope trade guy from Fast
Few
Money
years
a
ago,
few
yeah.
years ago. Yeah, we're just going to bring that up forever. Like you'll never live that one down. And
Oh,
actually,
well, it's something. Let me tell you something. That
I
was
know,
actually an incredible poll because
I know.
nobody was
I
talking
just
about Oracle back
no one
then.
was, and you were talking about the IBM. My only point
Sure.
was we're just never going to stop talking
Yeah,
about the hope
no,
trade.
nor should
All right,
we.
pull up the day chart in Oracle, and I think this is an interesting headline. And this is the sort of stuff that you might start to hear if the sentiment starts shifting, guy, towards this, AI trade. So the headlines are Musk's XAI, Oracle end talks on server deal, XAI buying chips to build data center on own, Oracle extends decline to 3.6%. Okay, so what's really interesting about this is that remember that story a few weeks ago that XAI or excuse me, it was Tesla, who was buying like tons of these, these high-end GPUs from NVIDIA. They moved them over to XAI. So just to be clear, XAI is Elon Musk's AI company. They're trying to build large language models. So I just think it's interesting that we're getting to a point where some customers don't need the chips that they've bought. And then I don't know what this means, but the fact that Oracle and XAI were in talks to build data centers, and now they're not anymore. Is XAI pushing stuff out, guy? I mean, like it's kind of an interesting headline, and we got to kind of go through some of the details of this to figure out what's going on.
It's interesting, and again, to quote Doug, but other people have mentioned this as well. I mean, what's fascinating about where we are right now is people are pinning their hopes to continued earnings growth of the magnitude, or maybe slightly less of the magnitude that we've seen with a number of these different names. But what history will tell you is you can have continued earnings growth, but what winds up happening is the multiple catches up to you at some point. And even if you're still sort of doing well by normal standards, you get clipped on the multiple side of things. And that's happened throughout history. So as you say, and I'll borrow a phrase from you, have at it, people. But not only have individual stocks gotten themselves really expensive, but the broader market, and we don't talk about this probably enough either, but the Buffett indicator, which everybody sort of swore by for years, is absolutely flashing bright red as well.
Yeah. So really quickly, let's pull up the 1-year chart of Oracle. And Guy, I think this is interesting. We've talked, I think yesterday on Market Call, we were talking about no shortage of tech names that gapped lower, okay, in that late April period, early May, when they were reporting Q1 earnings, and then just filled in those gaps. And, the one thing is, I'll just say, is that if we're getting towards a top, you know what I mean, for whatever reason, I mean, we talked about last July into October, the S&P sold off, 11%. You might see some of these upside gaps, guys, start to get filled in. We saw downside gaps get filled in, but let's see where Oracle stops right here.
Well, I mean, if you look at this chart, it seems logical that you still have some room to the downside, probably in the form of whatever that June, probably early June high of 128 and change.
Yeah.
And I don't know if Jacob and or Amanda can pull the cursor over that, but yeah, that's probably where it gets you. And, that's the setup. What's going to be, look at me. I mean, that's pretty damn. So
higher.
The interesting here is, I think the stock made an all-time high earlier today. If it didn't, it missed by, maybe 7 or 8 cents. Again, not that that matters, but if it continues this price action and you have a gap open lower tomorrow, and Carter can speak to this, then you're going to have all the technicians talking about sort of these island reversals as well. So to your bigger, broader point, though, there are still, all those unfilled gaps, whatever that were left to the upside, seemingly have been filled. And Carter talked about this 8 or 9 months ago. We should probably do sort of a refresh on that. All the gaps in the S&P chart, at least, that are left to be filled are on the downside.
Yeah. Last thing I'll just say, as far as Oracle's concerned, expected earnings and sales growth, fiscal, 2025, which is what it's in right now, Guy, is, about 11, 12% or so for both, trading at about 22 times. So, just one turn or so over what the market multiple is. So again, this is not that expensive a stock, especially versus some of the others, but if they're losing some of these data center deals, who knows? All right, guys, should we bring him in? Carter.
Why not? It's been a while. I miss him.
Do it. Carter, how are you?
Wow, look
What's
at
up?
him.
You guys are, who was the, I was, when you were talking about what is someone saying it'll never go down again? That's, of course, the most famous instance of that is that Irving Fisher, right? The economist in 1929 in September, who, what was it? Something like stocks have reached a permanently high plateau or something. It's always dangerous to make great declarations.
Speaking platitudes, you're right about
Yes,
that.
superlatives and so forth. I mean, he was a Yale undergrad, Yale economist, had the first PhD ever awarded from the University of Yale in economics. And, it just shows you got to be careful. Hubris is a hell of a thing. But to be fair, those who've expressed any caution, such as myself or anyone else, those who have been doubting in any way, don't get to reap the rewards of a runaway market. For myself, I'm always long and short, and I try to pick my spots. You're never fully short or fully long. You got to play it as you see it. But it turns out from time to time, just being blindly long works, and it works until it doesn't. And so there we have it.
Yeah. Well, you know that expression, Guy, in any bull market, a blind squirrel can find a nut. And I think there's lots of nuts being collected here. But, one of the things that it seems like kind of interesting, and Guy and I talked about this a little bit, Carter, it seems like the breadth is narrowing. It seems that, like on a day like today, the SMH is down and, NVIDIA was up nearly 4%. It's only up 1.5%. I feel there's not too many semis that are up right now, you know what I mean? And all the software stocks are down and down meaningfully. So again, it just seems like, the correlations are probably stacking up a little bit, and it seems like we're kind of due, so hey, Guy, do you want to run us through the S&P futures?
Why
here?
not? Let's do it, because here we are. We'll take a first look at our chart, Carter. We have put the channel in, the up channel that's in place. We have our 200-day moving average in place as well. I mean, again, these pale in comparison to year, but this is sort of the work that we've been doing for a while. And, you look at it, still intact. I mean, I guess we sort of tested the lower band of the uptrend couple weeks, or week and a half or so ago. We're bouncing again. I mean, I guess logic would suggest that if we just tested the lower band, at some point we're going to test the upper band. So that's what we've drawn. Your thoughts on that?
Well, so we know we had that dip, right? So it was about 15 sessions from late March to the third week in April, and that was about 6% for the S&P. And of course, then we've gone on from there. We're up 13% from that low. That's the channel you've drawn, and every day it's ticked higher. Not the case with so many stocks. We know, for instance, that it continues to be a very bifurcated market. And the next big thing to come along is, of course, the earnings that are coming out in the next 12 to 20 sessions. It's not the CPI. Look, 10-year yields are just mired in a spot that it's whether you want to call it Goldilocks or irrelevant, but that's the truth, right? It's now going to be corporate results, and do the extended names take a hit because the numbers aren't good enough? Do they extend further because they're blowout even better than are anticipated? And what in turn does the market do? Again, I think you trim.
Yeah. Carter, it's interesting though, if you just now let's look at the NASDAQ 100 futures, the E-minis here, and this has a slightly different bent to it. And this is the sort of thing that you were just talking about, and this is the concentration. So the S&P, this was up 3.5% last week alone, right? And so it just seems like like it's just getting a little toppy, a little extended. How do you think of this uptrend channel? Because it looks a little different, where the S&P was kind of in the middle. It had some more range, to that upper bend. But what is this saying to you right here?
Sure. I mean, I think the main thing to consider is that in that entire circumstance of being up within a channel is not the case with the equal weight, right? So if you look at the equal weight NASDAQ 100, one man, one vote, one woman, one vote, every stock's got 1% versus the 50% weight in the top 10, 12. It has still not really made new highs. Its high when the breadth was peaking was, I don't know, March 2022, right around in there, maybe a little earlier. But here we are again, 3-4 months later, and an equal weight NASDAQ 100. So it's the same circumstance throughout the market. Whether it's the S&P versus the equal weight S&P, the NASDAQ 100 versus the NASDAQ 100 equal weight. It's, a few names that are doing all the heavy lifting. And we have this constant rotation. When something might be struggling a bit like Meta, well, then Tesla comes to the fore, right? And somehow a perpetual motion machine that is the nature of the aggregate. And you have record low or close to record low outperformance in terms of mutual funds that are benched to the S&P, which is the nature of an index when it's so concentrated in just a few names.
You mentioned yields, so let's take a look at, and you're right to point out, by the way, that they're really nowhere, but the volatility in middle of nowhere has been somewhat interesting. We got down to 420 after getting up to sort of 4.5. Here we are straddling 430. I mean, again, this is our down channel that we drew yesterday as well. I'm not suggesting it's right by any stretch, but we're smack in the middle of it, and we're probably right at the move. Well, we're just shy of the moving average as well, which is clearly flattening out. So I'm pretty sure I know what you're going to say, and you've been right to say it, but we're sort of in no man's land, I guess.
Yeah, I mean, again, you have to always suspend one's bias because it says 10-year yield. Who cares about that? What if this was a mid-cap software stock? What if this was micro-cap, retailer? What if it was a super-cap tech? It's just not at any particular juncture. Now, one could see it differently, and that's fine. But that's what a pair of twos is. But because it is the 10-year yield, it does matter because it's neither higher for longer, nor have we sunk down into levels which suggest true contraction or something wrong on Main Street. So we continue to be in this, and it's a bizarre word, but this what might be considered perfect equilibrium, the word Goldilocks, and the market seems to be interpreting it that way, hence the ever-expanding multiple in the S&P 500 and other equities, and the up and to the right nature of most aggregates.
Yeah. Hey, Carter, one of the things that is kind of interesting to me is that the narrative for money center banks was like, if rates go higher, it kind of highlights some of the problems that maybe some more than others have on their balance sheets, right? And then, rates go lower. So, but banks haven't cared, right? Let's pull up the BKX for a second here. Higher rates, they've been doing fine this year. Lower rates, they're doing fine this year. This BKX looks like it wants to break out, whereas I think it's a probably pretty difficult setup as we kind of go into Friday morning when I think we have JP Morgan, Wells, and Citi, and maybe they could pull up a JP Morgan chart really quickly here. It looks a little different than this BKX. It kind of already broke out. It's making a little bit of a flag. Thoughts here on the banks as you head into earnings?
Yeah, I mean, in and of itself, it's the same exercise. If you didn't know what it was right away when the word banks, bias, and what are the charge-offs, not yours, you generically. We all have it, right? Oh, it's JP Morgan, it's outperformed, its relative performance to all their banks is so good. Citi's the one that's been playing catch-up. Citi has more international exposure. Get rid of all that. Listen, if you looked at the chart, you'd say, hey, it's a hold. It's stay long, be long. There's nothing to read into it. Now, there was something out just today, one of the big trading desks making a comment, you'll get a 90 basis point move if the CPI, no kidding, the average stock in any given day, the average index is 60, 40 basis points. So we move 90. That's not news. So JP Morgan's up, but implied move, I mean, it's probably 2%, right? I think it is 2.
It's a little more. It's like 3. It's almost 3%. But Guy, let me ask you this. I mean, when you think about the data that we've seen, if the Fed, potential rate cut odds are going higher, right, for September because the economy is slowing, like how are these large money center banks not going to be affected? That's the real question I have.
Yeah, well, and that's the right question. But what's wind up happening is, to your earlier point, they win seemingly in every environment that we can come up with because of the fact that they position themselves that way. And there's a lot of talk about Basel III and capital requirements, and a lot of hope that the very restrictive nature is going to sort of be, I guess, ratcheted back a bit, for lack of a better phrase. And I think there's a lot of hope, and I think a lot of these banks are trying to get ahead of that. So listen, I get it, but what's happening with some of the small and regional banks, which is what we talk about a lot as well, that's where there should be some concern. And if the economy, in fact, is slowing, those banks are the ones who are going to get the hardest hit. And that's why I think they've underperformed as vastly as they have.
Yeah. Carter, you had a note out the other day that got us thinking a little bit about the oil patch, if you will. And, we took a couple headlines, one about demand, another about margins. Guy, before we get to the charts of crude oil here, thoughts here, because this has been, crude, the underlying has been very volatile over the last year, but it's trading very near where it was just a year ago, right? So it's been a great trading vehicle. The equities, large integrateds and the like, they've also been, sort of volatile here too. Give us your 411 guy on how you're thinking of the space, especially as we just talked about, if there is cooler demand if the economy globally is slowing a little bit?
Yeah, it's interesting. I read these headlines too, and we send, just getting inside baseball a bit. We're constantly texting each other sort of stories and things we want to talk about, and we all sort of found our way to this. And I get it, and there's probably a lot of truth to this. But then I'm starting to wonder out loud to myself. I'm saying, what's really going on here? And maybe this is some attempt, at least for some of these energy companies, to sort of take the bullseye off their back, because they're obviously pretty much ground zero for the corporate greed that a lot of politicians are talking about. So I do think there's an element of truth to what they're saying. I also think there's probably an embellishment as well, because some EIA stats came out recently where they thought they'd see higher demand on crude, and they actually ratcheted up some of their price forecasts. So I get it. I see what's happening. And I will say this, the stocks haven't traded particularly well recently. And we're going to look at some crude charts, which suggests maybe we just topped out as well in the underlying commodity.
Yeah, Carter, bring it to us here, because you had a note out to
Yeah.
charting subscribers this, I think this morning or yesterday.
Yeah, with fading oil. The curious thing, of course, is there's the commodity, and then there's the shares, right? The equities related to oil, and I've got that as an overweight recently done because ultimately, with the exception of the COVID circumstance, bear market, that's of course nobody was driving, no one was moving. Energy shares, by virtue of their defensive nature, Exxon and Chevron in particular, typically outperform during market drawdowns, right? So in 2000, when the market peaked, energy outperformed the market in 2000, 2001, 2003, and so forth. And same when the market was going down in 07 and 08, energy shares, again, exhibiting relative performance. So it's a tricky thing to not like oil, which I don't. I think you fade it, and yet taking the sort of respecting the perspective relative performance associated with the defensive nature of being integrated. So
let's take a look at your crude chart, Carter, because I think this is what really you get the visual here, and you can see where we just traded up to.
Yeah. I mean, it was whenever this was 2 days last week. Hey, fade it, and does it have to stop at that line? No, but that's the thought, and we've backed off a bit here. I think it's a difficult level. So a big move, 73 to 83. And now sell, not buy. I don't know if there are any other iterations, but this chart really depicts it. You see the spike, Russia invades Ukraine. Wall Street, interesting at the time, crude goes to 130 a barrel. There were 250 price targets, 250, because of the nature of extrapolation. None of that occurs. And then here we are. I think you sell it.
Yeah.
So go ahead, Dan.
Yeah, no, I want to pull up my chart, guy, and I see exactly what Carter sees. Mine's a bit more short term here. I'm just kind of attaching it to the 52-week high. I'm taking it down to that April high. You see it, just like, to use your expression, Carter, it really, lines up in this latest, after this latest move, to the penny here a little bit. I just drew a short little uptrend. We're just below it on today's action. And so to me, I like your charts. This is one that kind of makes some sense to me. I see the 200-day moving average down there at like 79 and a quarter. Your 150-day is probably a little bit higher. So I want to look to trade this, using futures here. I want to sell crude at $82. I want to use an 84.5 stop. That's that recent high that we got to just a few trading sessions ago. My initial target would be that 79 and a quarter, that 200-day. But obviously, if it keeps going, I'm going to lower that stop to the upside and kind of play for maybe a retracement of half that recent move, guy. Thoughts there, because it seems like, after this move, you've been, you sound a tad more cautious than you might have been maybe a month or so ago.
I only because I've been beaten over the head so many times. Each time I thought we were on the verge of breaking out, and it's happened, a handful of times, if not more. It's been thwarted, and it's a lot of times it's thwarted at Carter's level, and other times it just sort of runs out of steam at seemingly levels that don't really line up with anything in particular. So I think in terms of the risk reward, given the last 6 months, 9 months of the way it's traded, it makes a lot of sense. And I think you're right to have that stop level. I also think you're right that if it starts moving in your way in a dramatic fashion, you can lower your stop. You can almost lower your stop to where your entry point is. Probably not exactly, but you can obviously start to mitigate some of that risk if you're right. Your initial target makes sense. I mean, that lines up, if you go back to the prior chart, with what theoretically should be some support in the form of the moving average, which will probably be about 79 and change-ish off of time decay, but makes a lot of sense to me, Dan.
Yeah, and here's another one that you kind of been all over, and that would be gold. And we get a lot of questions about this every time we open up Market Call to Questions. But you and Danny Moses have been kind of pounding the table for a while. It's interesting now that the dollar, which had a big move higher, it kind of corresponded with the consolidation that we've seen in gold over the last couple of months or so. And you've liked this consolidation a little bit, Guy. You think it's kind of setting the stage for a move higher. Carter, we just thought it would be a great opportunity for you to do a little chart check here.
Yeah. Yeah, no change, just long and strong, as the expression goes. I think there's a lot of room to run, silver even more so. But let's look at the charts. This is one way. Second, let's flash those back and forth. The lines draw themselves. One more. There's a third iteration. It doesn't matter what you call an ascending triangle, a wedge, a pennant. It's not about that. It's about something goes from 2,000 to 2,400. It's entitled to consolidate, rest, and in principle, well, not always, this rest and consolidation is resolved in the direction of the preceding move. So 2,000, 2,400, big move up. Itself was a breakout, and then consolidating 3-4 months, more often than not, up and out. Longer term charts, this is in 2000, Cisco is worth more than any company in the world, and nobody wanted gold. Of course, it's ever thus. That's the time to buy gold and sell Cisco. Here's the beautiful uptrend. And we only recently, in a meaningful way, got above the peak of 2011. Drawn a different way, doesn't matter what you call it. It's just early stages of what should be an important move higher. So again, I think one needs to have exposure to this commodity as well as to the mining stocks. Just while we're on this, and it's worth noting, this is important actually, take 3 minutes. So as a child, I would go into Merrill Siebert or Quick and Riley. You go into these brokerage firms, and Merrill would have them too, and some of the old firms. They would give you, they'd always have on the counter, they'd have out these pamphlets, and it would be a pie, nice colors, this much for stocks, this much for bonds, this much for cash, and they always had a wedge for gold, typically 5, sometimes 7%, depending on the house. E.F. Hutton might be different than Solomon Bus. And then in the year 1999, I have pamphlet that changed. All of a sudden, the gold piece of the pie disappeared. They all started to stop publishing it. So it was just stocks, which went bigger, bonds and cash. And they just said, the gold, what happened to that one? Oh, that we don't eat that kind of pie anymore. But guess what? That was the exact time when they all capitulated to buy gold. Anyway, and then this, of course, is a good way to maybe end it. Gold, people say, oh, well, gold versus the S&P. Well, gold doesn't have a dividend. This chart depicts gold with the S&P total return. That's with dividends reinvested. And 85 to 90% of people, and you can look this up, do not reinvest the dividends. They take them and buy boats or go on vacation. So, or pay for braces or tuition or whatever goddamn else. So here's the thing. That chart means that it's very humbling. Being long gold has been just as good as all of the fraught effort to figure out Apple versus JP Morgan and IBM and Cisco and Walmart and Lululemon and every other thing. Gold.
It's interesting. Yeah. And it's interesting there about that time frame, because I was actually involved in that world. There was and Amanda might be able to put this in the show notes. I don't even know if it's possible, but there was the Prime Minister of Great Britain, or the Chancellor or whatever he was called, was a guy named Gordon Brown. And he made the decision that they were going to sell basically half of the gold reserves of Great Britain. And it took place over the course of a couple of years. I think they sold like 400 tons of gold. And that basically marked the bottom. And it's Carter just said, it's something called, in our world, it's called Brown's bottom. And the prices never look back. And Dan's probably looking it up right now, but it's factually true. And that comes at the same time that Carter was just saying, the E.F. Huttons of the world, if they were still existed, they were taking the that pie portion of the equation out.
Yeah, no doubt. So, Guy, again, let's go to your chart here for a second on gold. And, it looks like, Carter's ready to buy this thing. You're ready to look at it in the futures and kind of set up for a trade here to kind of break above that double top after this consolidation.
I think, look, again, and this is not something I've run all that far from, but let's put up the way that I think we should trade this. And it comes in the form of buying it right here. And I think right here when we did it was sort of 23.65 or so. The stop is these recent lows, and you can see them, 2,300. I think that makes sense. You want to sort of keep it tight to the vest. And the initial target is something that Carter's outlined with the arrows pointing to the upside. So I think that first target is right. What I will say is, I think this is one that if it starts heading that way in a meaningful fashion, this is one you might want to add to on strength. And that's the one chart we want to look at. But the other thing, and I think the catalyst, and I'll say this again for probably the 40th or 50th time, I think it's going to come in the form of what's going on in dollar yen. And if Amanda can pull up, or Jacob, a dollar yen chart, JPY, you'll see we're back through 161 on the upside. Yen continues to weaken. By the way, that's taking place where JGB's made, I think, yesterday a 13-year high in terms of yield. So you have a weakening currency in Japan continuing, and you have rates going higher, which doesn't really, at least textbook-wise, make a whole hell of a lot of sense. And what it suggests is they have a bit of a problem. And I think nobody really wants to talk about it, and nobody will say it. I do think there's a bit of a currency crisis here. And historically, gold is a place you want to be if, in fact, this takes place.
Yeah, no doubt. While we're looking at gold, let's look at nerd gold for a second. And before we get to Carter's chart, that would be the Bitcoin. Before we get to Carter's charts, maybe Amanda can just pull up a 1 year on FactSet really quickly. We have Bitcoin trading like 57,600. Back in March, I think it made a high of just 7,300, maybe close to 7,400. You see that moving average where it's gotten to a little bit. And I just think that's kind of worth looking at right here, because we were below 30,000 last summer or so. So we're still up nearly 100% or so. So Carter, run us through what you're seeing, and what one of the reasons why this caught our eye, because how gold's been consolidating. Bitcoin's come in pretty sharply, at least 20% or so, and the dollar's come in a little bit.
Yeah. So it's about, just in the past 2 years from that low of January 2023, it's the fourth or fifth 20% plus sell-off dip correction. But let's put some lines in. This again, kind of draw themselves. That's the beauty of it. It hits it to the penny. And whether you call it a double top or not, it's perfectly reasonable to, when finally getting back to a well-defined former high, to back away. You typically back away or back or fill, and then ultimately you can break out. So to my eye, this is a pretty straightforward circumstance. The arrows draw themselves. There they are. I don't remember if we have other shorter term ones. Yeah, take a look. So let's put the channel in, mathematically parallel lines. Let's put the lines in, the arrows. And that was the low of just 2 days ago, and we've bounced a bit off there. I'm a buyer here. I think this is a weakness to take advantage of.
Theoretically, we should stop here. And what I find really interesting, and again, I don't know all that much about Bitcoin. You two have forgotten more than I'll know. But I'll say this: as rate cut expectations have been pulled forward, which they have been recently, I thought that would have been supportive of Bitcoin, but it's been exactly the opposite. So I'm not really sure what's going on here. Like, I don't know what the catalyst has been over the last, couple weeks specifically, that has taken it from sort of 70,000 to either side of 55,000, Dan.
Yeah, it's interesting. This year, there was a lot of excitement. If you just look at that ramp from, earlier in the spring, it had to do with, Bitcoin ETFs being approved, right? And then there was excitement about, Ethereum ETFs, going to get the same sort of approval, and that got pushed out a little bit. And so I think maybe, and then there was a halving and all that sort of stuff. I just think that, it's probably run out of catalysts in the near term. So let's see how it acts technically. I know one thing that a lot of Bitcoin traders, they have a lot more vehicles right now to kind of like, express their views in a way. So we're looking at the futures right here, and that's one way that people use to hedge, and whether it's hedging spot or there's options now. There's a whole host of different ways to kind of get in this market. So, a lot of these folks use technicals, and that's one of the reasons why I think, to Carter's point, is that these are mathematically perfect lines, right? And so if they do hold there, then there's probably a good probability that this thing is back above 60,000 in the not too distant future, and then maybe it's on its way to 70,000. If it breaks, you tell me where the support is. It's probably down at 40,000, which was that low earlier this year. So again, it's just worth noting. It's worth tracking the expectations for rates and what dollars does on the back of that, and then maybe how to trade this Bitcoin. Carter, you had a post on Worth Charting on restaurants, and some of these things I know have caught guys' eye of late. We've been talking about McDonald's, I think, all year long, and the relative underperformance, but there's a few other names that are starting to act kind of poorly, and broken some like long-standing uptrends and the like. And the Domino's really stuck out to us. And again, these are our charts, not yours. Tell us what you see here. You see that moving average. You see some consolidations in this chart. It was kind of a series of higher lows and higher highs. When you see this sort of reversal through,
right? The S&P 500 restaurant sub-industry group, or if you look at the Russell 3000, which has got 15, 20 names, from small things like Cracker Barrel and Cheesecake Factory to bigger names like McDonald's and Starbucks and Yum, Darden. Right now, that sub-industry group is making 10-year relative lows to the S&P. McDonald's been under a lot of pressure, so is Starbucks, as all know. But what we're seeing now is that the high flyers are starting to succumb. So right here on the screen, Domino's. But then the bigger ones, right, that are really, it's Wing, the darlings, not to say bigger, but darlings, Chipotle and Wing, are also giving way. And I think that's important. Now, again, is it the fundamentals? It's always something. Is it because labor costs are up, or because the cost of the corn or the beef or whatever is up, or the sugar for the Coke? Yes, it's always something. But the pattern is what matters. Great winners that are rolling.
That's something to look at real quick. If Amanda and or Jacob can pull up a longer term Domino's chart. This is a static one. Longer term, you'll see, Dan, we topped out, I want to say, like many stocks, December of 2021. And this recent run up that we've seen since November of last year pretty much got us right, well, almost back to those prior highs, I guess just short. So, a lot of technicians will look at this and say, we failed at a prior level, and that series of higher highs and higher lows has been broken. And then you're saying to yourself, okay, what's the level that makes sense in terms of support? And, maybe it does come in the form of the 200-day moving average.
So, Guy, you and I have done Fast Money together for a very long time. And I feel like, every time the CMG had a meaningful pullback, and this is a stock that's been very volatile, right? You've been a buyer of CMG. We know what your order is. If you watch Fast Money, you've made it very clear your burrito order. Do you just want to share that with the market call?
I will, because actually I'll say this, and if I had time, I'd run up and get the actual T-shirt they sent me. Yeah. So when I go into the Chipotle Mexican Grill, I order a burrito, and now apparently you can choose your, what are those things called? The wafer? What's the thing? The round thing.
The tortilla.
The tortilla. So now you can change. You can have like the regular tortilla, or like some whole wheat thing, which I will never get. So I get a regular tortilla, white rice, not that fugazi rice that they use, and then I get double chicken, no beans, please. Sour cream, medium salsa, and cheese.
Nice.
Yeah, that's a strong burrito.
It's a
strong burrito.
It's a double chicken and all the extra stuff left out, except for that.
It must be tough on your constitution, but that's we'll save that for.
Well, that's a price. Listen, that's a small price to pay, as they say.
So I just want to get a couple quick thoughts here. Okay, so it's down about 16% just in the last few weeks or so, and maybe they can pull up, a 10-year chart here, because I think it's really interesting. If you took the name, off of this chart, a 10-year chart, you might mistake it for like NVIDIA.
Technology, biotech. It's been crazy.
Like that. And this is an $80 billion market cap company. Now, I know that we've been used to talking about $1 trillion market cap companies, and many of them move $80 billion, a day, but this is a big market cap for, for this sector. So, Carter, thoughts on this? You're probably going to say it's not too different than the DPZ. Just curious what you're thinking here.
Yeah, it's listen, there are two ways to look at outliers in a group that is fairly homogeneous. Right now, you can have a better operator and has a new mousetrap like this Kava thing, which is, speaking of, I think it's sort of Mexican food. But at the end of the day, if it is, and it always is, around to the fundamentals, but the charts lead the fundamentals, people are obviously worried that maybe the consumer can't pay $15 for a Happy Meal or a Big Mac meal, and maybe the cost of corn or whatever, coffee is hurting Starbucks. But it's really about getting full. At some point, a stock is steep and uncorrected. Who's the incremental buyer? And it doesn't take much to set the thing off in the opposite direction, right? Someone sells, someone else sells, computers pick it up, and I buy, sell, hold, I'm a seller.
Yeah, and real quick, throw up a McDonald's chart before we get through a couple of questions. This is the one that's really bothered me, not necessarily McDonald's specific, but the commentary, Dan, out of McDonald's, I think it was 2 quarters ago, from the CFO. And again, you just said how long we've been doing Fast Money. In all our time there, I've never heard McDonald's talk about how their consumer was sort of feeling the pinch. And I'm paraphrasing to a point, but they actually said that costs were becoming a problem. And that to me was a huge warning sign, obviously for McDonald's, and that's proven to be correct in terms of the stock, but also in terms just of the state of the consumer and what the real economy is. So when you hear stuff like that from McDonald's, I mean, you can choose to ignore it, but you should really choose to listen, I would suggest.
Well, no doubt. And, Starbucks is very near its 52-week lows. This is a stock that traded as high as 107 in November. It's trading at 73.5 right now. Guy, was just on the Fast Money call. We were talking about some of these other consumer names. Look at Lulu. Look at Nike.
Lulu just made a 52-week low, I think, yesterday. I don't know where it is today, but yeah,
lower. Again.
Lower.
And the Nike, there's not a low enough for this one. You also mentioned, Guy, on our call, HELE. This is as we're getting ready. This is Helen of Troy. This is not a stock I'm too familiar with, but look at the gap here today. If they can move that chart over a little bit, there you go. Look at that bad boy.
Yeah, people, and if you go longer term, you'll sort of see where it's been and where it is now. I mean, people will say it's sort of Helen of Troy specific, and I'm sure yes, that is a portion of this, but this is like they own consumer brands. If you go to we were talking about it before, if you go to a CVS or a Walgreens, you needed to buy a humidifier or a thermometer or any of that shit, pardon me, Amanda, typically it's probably owned by some Helen of Troy company. I think Vicks is a Helen of Troy company. I think Braun Shavers as well. So, when you look at this, and if you go just look at the price action today, obviously, but recently, that's telling a story in and of itself. And people will say, Guy, you're cherry picking. And yeah, I guess, but you're trying to sort of look at anecdotal reasons to back up your assertion that the economy is not nearly as strong as a lot of people suggest. And, we have time after time and story after story. And at a certain point, anecdotal becomes a bit of more of a thesis. And I think that's what you're seeing now.
All right, let's do a couple quick questions.
I got them. You ready?
Of course you got them.
All right. This is from Ramash B. How does one choose between gold in the form of GDX or silver SLV, and which one has higher potential rate of return in, say, 2 years? That's a good question, Carter. I'm going to give a shot, and then you chime in. If you look at gold effectively at an all-time high, which it is, let's just not split hairs. Silver is a tad more than half of its prior all-time high. And I'm not suggesting that silver is going back to its prior all-time high, but if silver can just get back to maybe 75% of where it was. I mean, you're talking about a commodity that has room, I think, somewhere between 37 and $40. And I don't think that's a stretch. And you're starting to see it manifest itself in some of the underlying names. For example, Pan American Silver, Amanda, PAAS, if you want to throw that up. So, I do like gold. This is not me saying don't be in gold, but I think silver might have more of a run rate here. Carter?
Yeah, I think, well, surely. So if one is being aggressive, there's more beta in silver. But I think the question also was SLV versus GDX. One is a metal. SLV is trying to capture silver, the commodity, and GDX is gold miners, not GLD. But one doesn't have to choose. Do both. Whatever money you're intending to commit to this theme or thesis, split it up. Do both.
From John Anderson, real quick, Dan. And you know, John, by the way, John, thank you for everything. I know Amanda, Carter, Dan, everybody at the team says thank you for all of your support. He's asking about our thoughts on Palantir. So as Dan just mentioned, my hope trade, the P in the hope trade back in the day was Palantir. And I will tell you, I looked like a freaking genius early on because I think the stock went to about $35 or so. And then it spent the rest of 2021 cascading lower. I've thought for a long time, and I don't know if Dan has any thoughts or not, but if Palantir can ever sort of get into, instead of being so government dependent, get into some of these medium-sized businesses, the stock was going to start to take off. And you started to see that in the middle of 2023 or so. And to a certain extent, there's been some continuation. I think it made a 52-week high today, if I'm not mistaken. Maybe I'm wrong, but close. I still like it. You know, I still think there's some runway here in Palantir, Dan.
Yeah, I guess my only concern here, Guy, is this is trading at 22 times sales this year, about 19 times next. And, you know, on an adjusted earnings basis, it looks like it's making a little bit of money, and it looks like, you know, earnings are growing. But on a GAAP basis, there's really no earnings, right? And so if you think about, you know, this is a company that obviously has a high gross margin. I don't mean obviously, but a lot of software companies like this, 83%, right? So they have a revenue run rate here, expected $2.7 billion this year, 3.26 next. That's about 20%, right? With no real earnings growth. So if I look at this total number of 2.7 billion in fiscal 2024, right? And I look at net income, GAAP net income, they're just not making a whole heck of a lot of money. So trading at 82 times this year and 70 times next, there's not a lot of room if things start to slow down, right? And earnings guidance starts to miss. So again, good price action. I think it's probably in the right area in this sort of market to get that sort of, you know, performance, but it's not one I find particularly interesting here, especially after that move it's made.
Before we 5,000, Gary Webb, thoughts on XRT. And I will tell you, without even looking at it, XRT is going to look just like IWM. You're going to have a prior high a couple of years ago. Then you're going to have sideways price action over the last, 2 years, couple of moves. So go longer term and you'll see. I'm pretty much spot on. And I haven't looked at this in a while, but I know that, this is another one. This is like the transports, Carter, and like a few other things that, where the broader market is gone, you have not seen the commensurate move in a number of things, not least of which is the XRT.
Yeah, it just mired. This is such a great aggregation because it's literally 75, 80 names, and it's everything from Walmart and Target and Amazon to little things like Abercrombie, which is not that little anymore, AutoZone or Gap and so forth, but all equal weighted or close to it. And it's stuck. I mean, talk about something that's going nowhere fast and is not a particularly timely short or long to my eye, meaning just leave it alone.
I think that's right. Dan, I know you're a big fan of Brunson, so take us out with that tease.
Yeah, so you guys know it by now. All you guys, you ask, how can you help us out? Well, first things first, we appreciate you being here with us, whether it's live, whether you watch it later on YouTube, whether you find it in the podcast store. But that's Market Call. We also have the Market Matrix. That's MRKT Matrix. It's a daily podcast that we put out. It's AI generated. Guy, myself, the rest of our team, we take about 10 of what we think are the most interesting stories in the markets and the economy. We put them into a large language model. We summarize them. Then we put it into a voice bot, and we kind of get Brunson, and he reads them to you. You don't have to listen to Guy or me for a second there, but we think it's a great podcast. We're really excited about it. So please go follow it, go listen to it, share it, rate it, review it. That's how you can help us out. We find this one to be really interesting. So thanks.
I agree. I want to thank the Carter Braxton Worth. By the way, OK Computer, Dan and I are going to chat in a few minutes, but you sat down with Paul Rabel, who recently wrote a book, and we're going to do a giveaway there.
Yeah, no. So Paul Rabel is the founder of the PLL. That's the Premier Lacrosse League. He just wrote a book, The Way of the Champion. Paul's been on the pod with us before. He's often mentioned as in that GOAT conversation, Guy, that would be greatest of all time when it comes to lacrosse. But this book is not for lax bros only. And it was a great book. He spoke with so many people in sports, in business, in entertainment. The list goes on, and really talking about certain sort of, processes that all of these winners have. And I just thought it was a great read. So I hope you enjoy it. Go to OK Computer in the podcast store, rate it, review it, send that review to contact@riskreversal.com. We're going to send you a free book, The Way of the Champion. Carter, you should go do that if you want a free book. You would love it.
I'll do it.
All right. Thanks, guys.
Right.
Well, Carter is already a champion, so he knows the way of the champion. But that's it for today. Thanks for indulging us for the last 50 minutes. We will be back tomorrow. I think, if I'm not mistaken, Elizabeth Thomas, ET, will be joining us. Is that correct?
No doubt. And hopefully Carter will be back with us on Thursday. We appreciate you guys. We appreciate Carter being here. Guy Adami, I'll see you later.
Okay.